Welcome to Commercial Property Development Finance. I'm Georgina. This episode is our 2026 Market Outlook, a plain walk through how development finance actually works this year, who funds what, and how the numbers stack up on a real scheme. Before we go any further, one important point. We are an arranger and introducer of finance, not a lender, and we are not authorised by the Financial Conduct Authority. The lending we talk about is unregulated commercial lending. Everything you hear today is general market commentary. The figures are indicative, and nothing here is an offer or advice. With that said, let's get into it. So what is commercial property development finance? In simple terms, it is short-term funding that pays for building or converting commercial and mixed-use property, then gets repaid when the scheme is finished and either sold or refinanced. It funds the land and it funds the construction, drawn down in stages as the work progresses, so you are only paying interest on what you have actually taken rather than on the whole facility from day one. That staged structure is one of the things that makes development finance different from a simple loan. The lender releases money against the build as it happens, usually with a monitoring surveyor checking progress before each drawdown. It covers a wide spread of property: offices, warehouses, logistics, student accommodation, care homes, hotels, retail, leisure, industrial, mixed use, self-storage, data centres, life sciences, build to rent, and healthcare. If it is a commercial or mixed-use building going up or being converted, there is almost certainly a way to fund it. Now the 2026 backdrop. The Bank of England base rate sits at 3.75%, held steady since the cutback in December 2025. After a few choppy years of rates moving in both directions, that stability matters more than the headline number. Lenders can price with more confidence and developers can plan with more confidence. It does not make money cheap, but it does make it more predictable, and predictability is what gets schemes funded. When everyone in the chain can see where rates are likely to sit through the life of a build, appetite comes back, terms firm up, and deals that stalled in the uncertain years start moving again. That is broadly the mood we are seeing across the development market this year. Let's talk about how a lender actually sizes a development loan, because this is where a lot of people get caught out. There are two measures that matter, and the lender uses both. The first is loan to cost. Senior development finance will typically fund around 65 to 70% of total project cost, where cost means the land plus the build. The second is loan to gross development value, often shortened to loan to GDV. That is the loan measured against what the finished scheme is worth, and senior lenders usually cap that at 60 to 65%. Here is the key rule. The facility you actually get is the lower of those two figures. Not the higher one, the lower one. The lender protects itself on both fronts at once. Let me make that real with a worked example. Picture a scheme with a gross development value of £3 million and total costs of £2.2 million. On loan to cost, senior at 70% of cost gives you £1.54 million. On loan to GDV, capped at 65% of that £3 million value, you could in theory go up to £1.95 million. But remember the rule, the lender takes the lower of the two. So the maximum senior facility here is £1.54 million, the loan to cost figure, because it is smaller. The gap between that and the total cost is the developer's day one equity, the cash you put in up front. Working out that equity requirement early is one of the most useful things you can do before you ever approach a lender. Now, £1.54 million might not be as much funding as you want, and that brings us to the leverage ladder. Think of it as rungs you can climb to get more of your costs covered, each one adding a layer of finance behind the senior loan. At the bottom rung is senior on its own, around 65 to 70% of cost. Step up to stretched senior, and a single lender will go to roughly 75 to 80% of cost, taking on a bit more risk for a bit more return. Add a mezzanine layer on top of senior and you can reach about 85 to 90% of cost. And if you bring in a joint venture equity partner, the funding can stretch all the way up to 100% of cost. Let me explain those top rungs because they work differently. Mezzanine sits behind the senior loan in the queue to be repaid. Because it takes more risk, it is priced above the senior rate, and it is often structured as a coupon, an interest rate, plus a share of the profit at the end. Joint venture equity is different again. A JV partner is not charging you a rate at all. They are putting in cash alongside you in exchange for a share of the profit, and they can fund up to 100% of the cost. So the more you climb the ladder, the less of your own cash you need on day one, but the more of your finished profit you give away. That trade-off is the real decision, and it is worth modelling carefully before you commit. Let's move to the end of the project, because financing does not always stop when the building is finished. This is where development exit finance comes in. It is a bridge that you put in place at practical completion, the point where the building is physically done, and its job is to repay the original development loan. Why bother? 2 reasons. First, development loans are the most expensive money in the project, and once the construction risk is gone, you should not be paying construction level rates while you sell units or arrange a long-term refinance. Development exit finance is priced below the development loan it replaces, so it cuts your interest cost in the final stretch. Second, it buys you time and removes the pressure of a looming development loan deadline. It typically runs at a loan to value of up to 70 to 75% of the completed value on a term of 6 to 18 months. It is a quieter, cheaper bridge to carry you to the finish line. Next, permitted development finance, which is its own corner of the market and a busy one. This funds conversions carried out under permitted development rights, most commonly turning commercial buildings into residential. Think an old office becoming flats. The appeal is that permitted development rights can offer a faster route than a full planning application. But, and this is important, it is subject to prior approval from the local authority, and planning is always site-specific. What is allowed on one building down the road may not be allowed on yours. So before you bank on it, get proper professional planning advice. The finance can be arranged around the conversion, but the planning position has to be sound first. Let's talk rates and what drives them. Senior development finance generally runs at around 9 to 12% a year, with an arrangement fee of roughly 1 to 2% of the facility. Where you land in that range depends on a handful of things: how experienced you are as a developer, how much of your own equity is going in, the strength of the location, and the end values. How complex the build is, and how the lender views the exit, whether that is a sale or a refinance. A first-time developer on a tricky site will sit at the top of the range. An experienced developer with a strong track record and a clear exit will sit nearer the bottom. The base rate at 3.75% sets the floor under all of it, but the risk of your specific scheme decides the rest. It is also worth remembering that the rate is only one part of the cost. The arrangement fee, any exit fee, monitoring surveyor costs and legal fees all add up, so the headline rate and the true cost of finance are not the same thing. When you compare offers, compare the whole package, not just the percentage. So who actually provides this money? Let me run through the camps, and I will keep these generic, because the right one depends entirely on your scheme. Specialist development lenders are the workhorses of this market, set up specifically to fund construction and comfortable with staged drawdowns. Challenger banks sit alongside them and can be competitive on the right profile. Clearing banks, the big high street names, tend to be more cautious and selective, often best for larger, lower risk schemes with experienced borrowers. Debt funds bring institutional money and can move at scale and with flexibility. Mezzanine providers supply that layer behind the senior loan we talked about. And joint venture equity partners come in at the top of the ladder, sharing risk and profit rather than lending at a rate. We never recommend a single lender by name on this show. The job is matching your scheme to the right camp. That is really where we come in. As an arranger and introducer, our role is to understand your project, work out the sizing and the equity gap, and bring the right funders to the table from across all of those camps. We are not tied to any one lender, and we are not the lender ourselves. We help you see the whole ladder and choose the rung that fits. If you want to talk through a scheme, you can find Commercial Property Development Finance online, and the written guides behind this episode are authored by Matt Lenzie. Thank you for listening. Everything in this episode has been general market commentary. The figures are indicative only, and none of it is advice or an offer of finance. I'm Georgina, and I'll see you on the next one.